Welcome to the Whitwam Wealth Real Estate Podcast. Today's episode, Zero to Door.
Welcome to the Whitwam Wealth Real Estate Podcast with Scott Whitwam, your blueprint to financial abundance. Settle in as we explore the mindset and methods for wealth building through real estate.
Welcome back. I'm Scott Whitwam, and today's show is Zero to Door, how smart investors are buying property with little or no money down. Let's start with something that most people considering investing in real estate may not recognize. You don't need to be rich to invest in real estate. Let me say that again. You don't need to be rich to invest in real estate. Some of the most successful real estate investors I know started with almost nothing. No big savings, no high-income jobs, and no trust funds. They started with a strategy, with creativity, and with action. Today, I'm going to lay out how investors are buying properties with little or no money down out of their own pockets. To start with, many of the points we'll cover today can be found in my book, No Money Down, and I think we got a copy of it here. In this book, No Money Down, I deal with a bunch of the different topics. I won't have time to go over all of them today. And so you can pick up the book on Amazon, No Money Down by Scott Whitwam. And it has a lot of the processes for how we do what I'm going to talk about today. So let's dive in. Number one, the biggest myth in real estate. The biggest myth is this: it takes lots of money to invest. If you talk to a conventional lender, they may likely tell you that you have to have money in order to acquire an investment property. Unlike buying a home for yourself, where you can put 0 down VA, 3.5% down FHA, or maybe even some 3% down conventionals, to buy an investment property, you need 20% down and great credit to borrow the funds to purchase your first investment property. 20% down is how home buyers buy houses. That's not how smart real estate investors build portfolios. Investors use leverage, they use partnerships and creative financing. They focus on controlling property, or more importantly, controlling the profits of a property, not necessarily owning it. Once you understand and make this mindset shift, the way you look at real estate will just change. I mean, it dramatically, your investing outlook will completely change. The second thing is, who says it has to be your money? Even when we're investing in real estate, there's no rule that says that the money that you use has to be yours. A common strategy for acquiring real estate assets is to do maybe a joint venture. Though these deals can be assembled in many, many different ways, one of the common methods is one person finds the deal. We call them generally a bird dog. They're out looking for the deal. They find the deal and they bring it to another person who has the money. Let's say you snoop out, a great buy and hold property, and the property costs $350,000, right? But let's say it produces $750 a month in cash flow. Even if you have the cash to close the deal, you may not want to. Why not partner with somebody else? So now you can look at a deal, and even if you don't have the cash to close the deal, you partner with somebody else. They provide the money. You provide the deal. You provide the management of the deal and the structure and the execution of it. And then you divide the profits in whatever manner you and your JV partner agree to. Right? So we're using their money to buy the property, but you're profiting from it. In this case, you complete a real estate investment with little or no money down. And, in the early days, I've done some of these JVs where, I got part of the rental income, or I didn't get any of the rental income, but I've got a big check at the close of escrow. I mean, there's a lot of different ways that you can structure these. And this type of deal is happening every single day. I did this on a buy and hold many years ago. I was just thinking about that. I put up a couple of $100 in earnest money, right? So I found the deal. I talked to the seller. He represented the estate. His mom was out of state, but they wanted to sell this property. We came to an agreement on the terms, on the sale price of it. I put a couple $100 in earnest money down, and I called one of my JV partners. He paid for the inspection of the property, so I didn't have to, so he knew what was going on. He paid to do all of the repairs in the property, and he paid for the purchase price of the property, and I walked away with 10 grand just finding the deal. Besides that, this investor went on to do a bunch of deals with me. I was happy and profitable, and so was he. There are people with money, but they don't have time to find the deals. They don't have the skill to find the deals. And there are people who have, time and they have knowledge, but either they don't have money or they just want to leverage other people's money. They don't want to use any of their money at all. They can do JV deals. See, when you bring these two things together, that's when deals happen. My third thing is, let the seller be the bank. See, this is another powerful strategy for real estate investors. We call this seller financing. Seller financing means the seller acts just like the bank, just like a Wells Fargo, a Bank of America, a U.S. bank. The seller becomes the bank. Instead of you having to qualify for a loan from a bank or a hard money lender, you make payments directly to the seller. And you may ask yourself, well, why in the world would a seller ever want to do something like this? That doesn't make any sense. Well, here's some of the reasons why. A seller may value the monthly income more than a lump sum. For some people, that doesn't make any sense. But they may not need the full cash amount and would like to earn the returns, the interest rate that you're paying them on the loan. They may also have some capital gains issues. Receiving payments may be a better tax strategy for them because if they sell the property, they may have a huge capital gains hit and lose a lot of the value of what the property has to them at this point. But by taking payments, they may be able to defer some of the capital gains or reduce their capital gains on the property until a later date. Take, for example, the example here, a seller who owns a house free and clear. You offer a small down payment or sometimes even no down payment, right? You agree to purchase the property at a certain price. You agree to make all repairs. Now, if you're a really good negotiator, you get the house for zero down and negotiate for the seller to make all the repairs. Whatever you can negotiate, you get, right? You agree to a monthly payment amount, and the monthly payment amount may be the most important thing to the seller. So let me give you just an example. Let's say that if you put it on the open market and can rent the property for $1,000 a month, but you're offering him $1,500 a month, but you're not bringing any money down, and he's making repairs. This may keep all the cash in your account, and then you may rent this out to multiple tenants and be able to still cash flow it, even though he's getting more than market rent on it. You now control the property without needing traditional financing. Be aware that often sellers will carry financing, but only for a defined period of time. They expect what we call a balloon payment, which is a refinance of the property on your behalf. You would hold the property, for a certain period of time. Now, if you're flipping a property, you may not need like 72 months for a balloon or 120 months for a balloon or whatever. You can do a 10-year balloon, 120 months, 10-year balloon on it. But what if you're flipping the property? Maybe you agree with the seller who's financing it and giving you great payment terms. Maybe you agree not to sell this house for 1 year or 2 years. So you prepare it for a flip, you do all of the stuff you need to do, but maybe you put a tenant in it short term. Maybe you put a tenant in it for a 12-month period of time, and then you refinance it or you flip it and sell the property, meeting the hold period of time so that the person doesn't run into a capital gains issue for you flipping it in 60 days or something. I mean, you have to look at all these angles and make sure you run the numbers and make sure everything works. This strategy alone has built millions of dollars in wealth for investors. My fourth thing here is using other people's credit legally. What do you mean using other people's credit? Another strategy investors use is leveraging loans already existing on a property. We call this buying a property subject to. Subject to what? Subject to the existing loan that's on the property. Some people are willing to sell, and just like seller financing, where the seller is a bank, in this case, the seller's bank becomes your bank. One big advantage right now is that many of these sellers have very low interest loans, 2.75, 3, 3.25. That's low interest. And if you can buy it subject to that interest rate, where you don't have to go out and get a 6 or 7% investment loan or 8% investment loan, you take over the existing loan without refinancing. So sellers who are desperate to move because they're being relocated for work, or maybe they're unable to keep up with the mortgage payments, due to job loss, divorce, whatever the issue is, they're open to this kind of option. Subject to does have some legal limitations, and I caution you, just to make sure you know what you're doing, work with a good title company. Homes with FHA and VH financing are generally prohibited from this type of financing for you as an investor. However, there are title companies who will wrap a VA or FHA loan. They'll provide the title insurance. They'll allow you to do it subject to. The only issue is if it is discovered by FHA and VA, they are going to do what's called an acceleration. They're basically going to start a process of acceleration, which is a foreclosure process. And in that case, you don't need to be worried. You just refinance the property. So there are options to making this very powerful strategy work for you. Over time, the property itself strengthens your financial position. The property helps you to qualify for the next one and the next one and the next one. Maybe number 5 and then 10, right? Let somebody else pay. That is my fifth one here. I like it when other people are paying for my investment properties. You say, well, Scott, that's impossible. Other people aren't going to pay to buy your investment properties. Most of my very successful investors have built long-term wealth this way. They use what has been called, the buy, the rehab, the rent, the refinance, and repeat. So we let other people pay for the property. How does it work? You buy a property at a discount. You make all the repairs and improvements. So you increase the value of the property. Then you put a renter in it. You can do it traditional. You can do it with, a short term. You can do it by co-living. Then you refinance based on the new higher value and the income the property is generating. If done correctly, the refinance brings back all your original investment, and then your tenants pay off the mortgage. Isn't it great? Somebody else paying for your investment property. You recycle the same money into the next deal. Somebody else is paying your bills for you. Many investors use the same initial capital over and over and over again. One investment turns into 5, 5 turns into 10. This is one way to scale a portfolio, and somebody else is paying the bills. All right, my sixth one, sell a house you never own. But how many times have I heard people tell me, well, it's illegal. You can't sell a house you don't own. I've done it hundreds of times. First, let me caution you as investors. You got to check your state rules on wholesaling. Some states now require you to be licensed to use this method. My state, Arizona, does not. We simply now must just disclose that we are a wholesaler. And if we do the disclosure properly, you don't have to be licensed. And so a lot of investors start out by doing wholesaling because it's a very low entry point into the business. Wholesaling means finding a discounted property and then selling or assigning that contract to another investor for a fee. You don't actually own the property, but you control the deal. You have what is called equitable interest. The other investors pay you for finding the opportunity. That wholesalers regularly make $5,000, $10,000, $20,000 per deal. That's not bad for selling something you don't even own. And then they can use their profits to fund their own investments later. It's one of the fastest entry points into real estate investing with little or no money. The only challenge is that you have to be good at digging the best deals to ensure there's enough margin at the end for a final investor. Somebody who can buy it, do the rehab on it, and either hold it as a rental investment or sell it as a flip investment. All right, number 7, the more you know, the more you get paid. Here's the truth. Many starting out miss this. Okay, even some of my seasoned investor students miss this. Real estate investing is not about money first. It's about knowledge first. We get paid for solving problems. The bigger the problems you solve, the more money you make. When you understand the deals, the opportunities appear everywhere. Money always follows good deals. And that's why you hear me over and over and over again saying, make sure the numbers work. See, the numbers have to work. You know, profit doesn't follow action. It follows correct action. It follows the old adage that practice doesn't make perfect. Only perfect practice makes perfect. Investors don't chase money. Money chases good deals. All right, here's my 8th one. And this is about mindset shift. And I know that if you've watched this channel very long, you know I talk a lot about mindset and the mindset shift. The difference between someone who owns 10 properties and someone who owns 0 isn't luck. It isn't good breaks. It isn't market timing. It's correct action. Most people wait until they feel ready. Investors, generally are acting before they feel ready. Why? Because they have a mindset that allows them to dive into opportunity and not stop because of the fear of what may or may not happen. See, good investors, they learn to adapt and grow. It's likely your first real estate deal won't be perfect. And this reminds me of the former Oakland A. Mark McGwire. He's number 5 on the all-time home run list, but he didn't hit his first home run for 18 games in the major leagues. See, if you want to be an all-star in real estate investing, you got to have some good at-bats. And before long, you'll be hitting home runs. Real estate investing is very similar. The more base hits or small profit wins that you start out with, that helps to develop your confidence as an investor so you're in a place to start hitting home runs. And if you've been investing for a long time, maybe it's time to put this training into effect. Maybe put the training wheels back on your bike, get back to some basics, and find another way to elevate your business. Use some of these techniques you haven't used before to help build another vertical in your real estate investing business. All right, in closing, remember this. You don't need to be rich to start. What you need is knowledge, your mindset, a good strategy, and correct action. If you found this episode valuable, I just ask you to subscribe to our channel, leave us a review, share this with another investor who would benefit from hearing it. But that's all we've got for this episode. I want to thank you for joining me on the Whitwam Wealth Real Estate Podcast. Be sure to check out our previous episodes on related real estate investing topics. I'm glad you're part of our growing real estate community, and you can always find the Whitwam Wealth Real Estate Podcast on Apple Podcasts, Spotify, iHeart Podcasts, YouTube, or wherever you enjoy listening to podcasts. This is Scott Whitwam. Be sure to join me next time on an episode of the Whitwam Wealth Real Estate Podcast, where we're wealth building through real estate.